The digital frontier, once hailed as a realm of boundless innovation and decentralized finance, is facing increasing scrutiny from global financial powers. At the forefront of this regulatory pushback is China, a nation that has consistently demonstrated its resolve to control its financial landscape. The latest pronouncements from the People's Bank of China signal a continued and intensified crackdown on virtual currencies, raising fundamental questions about the future of cryptocurrency within the world's second-largest economy and setting a precedent that could influence regulatory approaches worldwide. This is not just about banning Bitcoin, it's about asserting control over the very nature of money in the digital age. China's relationship with cryptocurrencies has been tumultuous. Initially, the country was a significant hub for Bitcoin mining and trading, fueled by readily available cheap energy and a tech-savvy population eager to explore new financial opportunities. However, Beijing's stance began to harden as concerns grew about the potential for financial instability, capital flight, and illicit activities facilitated by these decentralized digital assets. The turning point came in 2021, when the Chinese government implemented a comprehensive ban on cryptocurrency trading and mining, effectively dismantling a once thriving industry. This decision was driven by a combination of factors, including the desire to maintain control over the financial system, promote the adoption of its own central bank digital currency, CBDC, and reduce the environmental impact of energy-intensive cryptocurrency mining operations. Despite the ban, virtual currency activities have persisted, albeit in a more clandestine manner, through the use of overseas exchanges and virtual private networks. The PBOC's recent statement underscores the government's determination to eradicate these remaining vestiges of the cryptocurrency ecosystem. The People's Bank of China's recent statement reiterates a firm commitment to suppressing virtual currency activities within its borders. This is not merely a restatement of existing policy, but a signal that the PBOC intends to escalate its efforts to enforce the ban on cryptocurrency trading and mining. The central bank explicitly vowed to maintain a high-pressure stance on virtual currency speculation and related financial activities. This suggests a more proactive approach to identifying and dismantling illicit cryptocurrency operations, potentially involving increased surveillance of financial transactions and greater collaboration with other government agencies. The PBOC also emphasized the importance of strengthening communication and coordination with other regulators to address virtual currency-related issues collectively. This indicates a move towards a more unified and comprehensive regulatory framework, aimed at preventing loopholes and ensuring that all relevant authorities are working in concert to enforce the ban. The PBOC's commitment extends beyond simply suppressing existing cryptocurrency activities. It also involves closely monitoring the development of virtual currencies and related technologies. This proactive approach suggests that the central bank is seeking to anticipate and mitigate potential risks posed by emerging digital assets, even those that may not yet be widely adopted. The PBOC's focus on stablecoins introduces a new layer of complexity to the ongoing debate surrounding virtual currencies. Stablecoins, designed to maintain a stable value relative to a reference asset like the US dollar, are often touted as a less volatile alternative to traditional cryptocurrencies. However, the PBOC views stablecoins as a potential threat to financial stability, citing concerns about their potential to disrupt the existing monetary system and facilitate illicit activities. The paradox lies in the fact that while China is actively developing its own CBDC, the ECNY, it is simultaneously cracking down on other forms of digital currency, including stablecoins. This raises questions about the government's true motivations. Is the crackdown solely driven by concerns about financial stability? Or is it also aimed at eliminating competition for the ECNY? Furthermore, the PBOC's emphasis on strengthening supervision of stablecoins and exploring regulatory measures to address their potential risks highlights the challenges of regulating decentralized digital assets. How can a central bank effectively supervise stablecoins that operate across borders and are not subject to traditional regulatory oversight? The PBOC's approach to stablecoins could serve as a model for other countries grappling with the same challenges, but it also raises concerns about the potential for overreach and the suppression of innovation. China's stance on virtual currency has significant implications, not only for the cryptocurrency industry but also for the global financial landscape. As the world's second-largest economy, China's regulatory decisions carry considerable weight and can influence the policies of other countries. The PBOC's crackdown on virtual currencies sends a clear message that Beijing is not willing to tolerate decentralized digital assets that could undermine its control over the financial system. This could discourage other countries from adopting a more permissive approach to cryptocurrencies, particularly those that are concerned about financial stability and capital flight. Furthermore, China's development and promotion of its own CBDC, the ECNY, represents a significant step towards the digitalization of money. If the ECNY gains widespread adoption, it could challenge the dominance of the US dollar and other traditional currencies, potentially reshaping the global financial order. The PBOC's actions also highlight the broader debate about the role of government in regulating emerging technologies. As digital assets become increasingly prevalent, governments around the world are grappling with the challenge of balancing innovation with the need to protect consumers and maintain financial stability. The immediate impact of China's crackdown is likely to be a further decline in cryptocurrency trading and mining activity within the country. While virtual currency activities have persisted despite the 2021 ban, the PBOC's renewed commitment to enforcement could make it more difficult for individuals and businesses to engage in these activities. This could lead to a further exodus of cryptocurrency-related businesses from China, as well as a decrease in demand for cryptocurrencies among Chinese investors. The crackdown could also have a ripple effect on the global cryptocurrency market, potentially leading to a decrease in prices and a reduction in trading volume. However, it is important to note that the cryptocurrency market is highly volatile and subject to a variety of factors, so it is difficult to predict the long-term impact of China's actions. The PBOC's focus on stablecoins could also have significant consequences for the stablecoin market. If China imposes strict regulations on stablecoins, it could discourage their use within the country and potentially lead to a decline in their overall market capitalization. This could also prompt other countries to adopt a more cautious approach to stablecoins, potentially hindering their growth and adoption. The future of cryptocurrency in China remains uncertain. While the PBOC has made it clear that it intends to maintain a high-pressure stance on virtual currency activities, it is difficult to predict whether it will be able to completely eradicate them. The decentralized nature of cryptocurrencies makes them difficult to regulate, and individuals and businesses may find ways to circumvent the ban, particularly through the use of overseas exchanges and virtual private networks. The success of the ECNY will also play a crucial role in shaping the future of cryptocurrency in China. If the ECNY gains widespread adoption, it could reduce the demand for other forms of digital currency, potentially making it easier for the government to enforce the ban. However, if the ECNY fails to gain traction, the demand for cryptocurrencies may persist, despite the government's efforts to suppress them. It will be crucial to monitor the PBOC's regulatory actions and the development of the ECNY to gain a better understanding of the future of cryptocurrency in China. The PBOC's approach to stablecoins will also be closely watched by other countries, as they grapple with the same challenges of regulating these emerging digital assets. China's unwavering stance against virtual currencies underscores its commitment to maintaining control over its financial system and promoting its own digital currency. The PBOC's renewed crackdown and its concerns about stablecoins signal a long and complex road ahead for the cryptocurrency industry within China. While the future remains uncertain, one thing is clear: Beijing is determined to shape the digital financial landscape on its own terms, a move that will undoubtedly have far-reaching consequences for the global financial system. The world will be watching closely to see how this unfolds, and what lessons can be learned from China's unique approach to regulating the digital frontier.